Hey everybody, Jeff Garber, mortgage expert, and this is video part 2 of probably a 3-part market update video because of all the economic reports that are coming out this week. And I wanted to break them all down for you to show you how they are going to affect mortgage rates and housing. So yesterday, July 27th, that was Wednesday, July 27th, was the start of this. And yesterday was Fed Day. And we already know, if you watched the video from yesterday or you watched the news, that the Federal Reserve raised short-term rates by 0.75%. Now, many think that mortgage rates were increased by 0.75%, but that did not happen. In fact, yesterday, mortgage rates actually improved a little bit on the news. And the reason why is because the Fed is raising rates to help get inflation to stop going up, eventually stabilize, and then ultimately come down. And mortgage rates and long-term rates will come down as inflation comes down. And so the bond market, where mortgage rates live, like the news, like what the Fed did yesterday, and therefore we were rewarded with a slight decrease in mortgage rates. Stock market also liked it yesterday and rallied a bit as well. They were also anticipating the Fed to increase rates by 0.75%. And because that's what we got and there were no surprises, stock market kind of like that. But today's a little bit different of a story because today is part 2. And today at 8:30 a.m. we got second quarter GDP, gross domestic product, and that came in negative. And the technical definition of a recession, although we're not in one and it won't be declared as one now, would be 2 consecutive quarters of negative growth, negative GDP growth. And first quarter GDP was negative, and the first reading of second quarter GDP, which came out today, was negative. There'll be a second reading in September, and then a third reading a month later. And if all 3 of those aren't revised upward and they stay negative, well, then all the signs are reporting to that either we're in recession now or that we're heading for one. All right, but we can't declare that yet. But so far, we are seeing the warning signs. We're seeing inverted yield curves, which typically lead to recession. And now we have 2 negative quarters of GDP. So all the signs are pointing towards recession. So what does that mean? Well, stock market didn't like that today. So the stock market is selling off. All right. We were expected to get a positive number by many in GDP, but since we got a negative, and recession typically is negative news, stock market didn't like that. All right, let me get myself out of the way. I'll show you what's happening in the bond market and with mortgage rates. So as I said in yesterday's video and many of my market update videos, if you're watching them, that mortgage rates come from the bond market, specifically mortgage-backed securities that trade in the bond market. And what you're looking at is live trading of mortgage bonds or mortgage-backed securities trading live right now as we speak. And the chart's really simple to read. We're looking for good news. Green is good news, red is bad news. And all you need to know that as we see green candlesticks and as our bond prices go higher, as you can see in this pattern here, going up, well, that means mortgage rates are coming down. So we're always rooting for bond prices to go up. Quick summary, if we go back to last month, June 15th, shocker of a Fed hike of 0.75 point. Shocker meaning that was a big hike, 0.75. You can see mortgage rates since last Fed hike have actually been improving. And you can clearly see that because we were all the way down here. And look where the bond market went, all the way up here. And we had some volatility, and then we leveled out a little bit. But then here we are at Fed week, which this green candlestick yesterday was the response to the Fed raising rates, which was good news, meaning they're going to fight inflation. So the bond market liked it. Mortgage rates improved. We are continuing our improvement today. Even though we got a negative GDP number, I think the bond market was expecting that. And the bond market is still rallying off of the Fed hike from yesterday, and that they actually see the Fed doing what they need to do to start to try to combat inflation. Now, we're not out of the woods yet. All right, tomorrow, Friday, we have the PCE, which is the Fed's favorite gauge of inflation. PCE stands for personal consumption expenditure. That comes out at 8:30 tomorrow morning and wraps up the trifecta of economic news that we have this week. And that will be a market mover. And we are expecting those inflation numbers to come in hotter and higher as well. If the bond market's expecting that as well, and it doesn't come in too much hotter, well, then our rally could continue. However, if the inflation numbers come in higher than expected, that could actually cause a reversal in the bond market here, and our rally could come to an end and possibly go the other direction where rates level out or go up again. All right, but I'm going to bring you all that information. I just wanted to let you know we're at day 2. If you're in real estate or following the markets, all right, this is good news so far. Mortgage rates came down. That's the key here. The media will tout that mortgage rates just went up 0.75%. That did not happen. All right, home equity lines go up, credit card rates go up, student loan rates go up, short-term lending rates go up when the Fed raises rates, but typically 30-year fixed rates come down because the Fed hike is designed to get inflation in check and get it where we need it to be. And inflation, as it comes down or is perceived to come down, long-term rates like mortgage rates can come down too. So this is good news so far, and I wanted to break that down for you. I will be back tomorrow with part 3, breaking down what happens with the PCE and inflation numbers. So until then, have a great day.